Thanks for joining me and for watching this video. I will be talking of gaps in technical analysis. I will try to explain to you in an easy way and with some example the importance of gaps and the different types of gaps. First of all, just a quick understanding on gaps. Why the gaps are so important? Because it's a tool of technical analysis that is there, and we need to take advantage on that. So because it's a very easy gap, it can just adds up more information of those prices. So perhaps if we saw a nice, I don't know, pattern that is a bullish pattern, and we got a different information, perhaps the RSI is confirming the direction of the price, etc., why not to add more information that is gonna confirm the direction of the trend? So we can do that. It's gonna be one more information, so it's gonna be a free information that we have. Why not to take it? Just take advantages of those gaps, please. And let's use it, and let's use to get confidence on the direction of the market, because they give us information, more information on the prices movement. And because our target with technical analysis is always to predict the future price, to predict where the price will move, the gap gives information that can help us to predict the prices. So that's why I think we have to use it. They are there, they are nice, they're easy to understand. Let's use them. So first of all, why there has to be a gap in a candlestick chart? Because it means that in that time, in that given time, there has not been any trading action, so no trading has taken place. It can happen. This is the situation where perhaps the market is bullish, is bullish very quickly, so it's growing up very quickly, so there are this jump upward, or on the other side where there are those jump downward, where the market is going down very quickly. And those gaps, when we saw those gaps, they give a signal of weakness in a downtrend and a signal of strength in uptrend. Important thing to know that the gap generally are commonly in daily charts and short-term charts. If there are gaps in monthly or weekly charts, they have to be considered, because I will take in consideration even for short-term analysis, because they have a very high significant. So it means they're very significant for our trading, especially for long-term investment. So let's get into more detail, and let's see the three different types of gaps. The first gap is breakaway gap. Just those are the information that we need to know on the breakaway gap. Please write down those information, take a screenshot. I'm not gonna go through those one, because I'm gonna go through those points through an example that is coming right now. Here it is. Those are the breakaway gaps. They are the gaps that happens at the start of generally the start of a new trend, let's say. So perhaps in this case, starting of the downtrend, starting of uptrend, and they are generally they happen just after a completion of an important price pattern. Perhaps was a sideways pattern, perhaps was an upward trend. So perfectly, so this is a very important price pattern, and then here it is our downside breakaway gap. This is a upside breakaway, this is a downside breakaway gap. So how can we use it to predict the prices? But it's easy, perfect. Why not use it? This one can work as support. Perfect, it worked as support for the is worked perfectly as support for the subsequent market corrections. So amazing. And in one other consideration, this one is a reversal condition, because first of all there is a island reversal pattern, but not forget about it for a while. But why it's important? Because a trend line has been violated, so this is a signal of weakness of the trend, a signal of reversion of the trend, and then this signal has been that point there has been even a downside breakaway gap that is gonna confirm, or is gonna give more confidence that this is a really reversal signal. So it means that we are adding more information to that reversal signal. So that signal is gaining importance. So we need to consider it. So once we know that the trend line is being violated, okay, the trend might reverse. But once we have even a gap, is one more information, we can be more confident that perhaps actually the market is really reversing, is really going downtrend. So that's why it's important, because those gaps, they just add information of the on the prices movement, and we can use it. We need to take advantages of those information to predict the future prices. So they generally those gaps, they generally happen where there are with high volume. In fact, there is high volume. In fact, there is high volume there, and then they sign the beginning of a significant market movement. Correct. This is uptrend. This is downtrend. They occur on heavy volume. We said it. Breaking or major trend line in reversal signal can also see a breakaway gap. This is what we just saw. Then the gap could be filled. That means that the price will go down up to the bottom of the gap. If this condition happen, it means that the market is still, it's a weakness sign, especially in uptrend. In downtrend, so it's gonna mean the same, but in opposite side. But so again, if the price is gonna fill up all the gap going down, then the level is gonna be below the gap. That is this one. It may be a weakness. This is a sign of weakness of this trend. This one is not happening here. Actually, there is always the gap has not been totally closed off, but this one worked. This one worked as support for this candle, and then this one is really this one you can find this one as support. I think this one was supposed to be the real support, but anyway, this is just to give an idea that it can work as support, even if sometimes, even it's not always. So let's go. Those are the main points. Again, please remind those points while trading. Let's move to the next slide. Next slide is the second type of gap. Is a runaway gap. Runaway gap or measuring gap is the one that happens during a trend. So it is in the middle of. Let's go to the example. It's much easier. It's generally in the middle of an uptrend or downtrend. This is important because if in this case there are more than one, there are two, but generally if there is one, what we can see that we know that generally the trend is gonna terminate just projecting this pattern there, and we can calculate the distance, and then we can say that we are expecting this trend to terminate almost there. Why that? Because generally those patterns happens at the end of happens in the middle of a trend. This is one of the main characteristics of runaway gap. That's why it's called the measuring gap, because we can measure we can, sorry about my pronunciation, we can measure the distance between the starting point and the middle of the trend. So yes, it's fine going ahead. Yeah, this is what we have. So this one at the end of this gap, perhaps it worked as support for this one, and then those are some of the main characteristics of those runaway gaps. Again, this one is downside breakaway gap, this one a breakaway gap. This is a different example from the previous one. This one is Microsoft, the previous one was Google. And then let's go to the the last gap, that is the exhaustion gap. This exhaustion gap is more it's at the end. Generally it's at the end of an uptrend or downtrend, and generally once the breakaway and runaway gaps have been identified, generally we have to expect that the exhaustion gap will happen. So because generally they always happen all together. So once the first two have been confirmed, have been identified, so actually there is been identified. It means that all we have to expect this exhaustion, this exhaustion gap. So let's move again with an example. Those are the main point of the exhaustion gap. Please remember those one. And then the main point is that the main point is at the end of the downtrend and uptrend. and again the gap has been filled and the price goes below it. So this is generally what happens. This one is a sign of weakness of the trend. In fact, then at the end it will reverse. At the end it will reverse. I mean, after a couple of this is daily chart. After a couple of weeks, I think it will reverse. And this is exactly is forming an island reversal pattern. Island reversal pattern is called island because it's between two gaps as it is now, and generally it means that the trend is gonna reverse, is gonna the uptrend in this case went to became a downtrend. So this is the main concept of island reversal pattern. It's very easy. It's trend reversal. It's just a reversal signal. It's surrounding by two gaps left and right as we saw, and then it has to last days or weeks. It lasted 2 weeks, and it has to narrow it has to move in a narrow range. So that's all for now. I hope you enjoyed these lessons, but please take those examples, and if you go, you can find, if you know you have the dates, the time that you have the daily, you have the stock, you go there, you find exactly what those gaps. This was because this one has been done on a daily chart. You know, while trading, I found those gaps, and now I'm sharing with you. That's all. Thanks for watching this video, and see you in the next video.